Welcome all you multifamily maniacs to the Multifamily Real Estate Experiment podcast. I'm Dr. Heath Jones.
And I'm Hutch, the marine investor.
All right, we have a very exciting show today. Today we're asking the question, how do you become a successful passive investor with multifamily property? Our guest today started investing in 2009 and has been involved with multifamily, single family, and vacation rentals as far as his real estate career. After saving money to invest via extreme budgeting, he is now a full-time passive investor. I think that's the goal we're all reaching for, right? He is currently the Director of Investor Relations at Ashcroft Capital. Ashcroft Capital is a national real estate investment firm that controls over $915 million worth of real estate under management. We'd like to welcome Mr. Travis Watt. How are you doing, sir?
Hey, Hutch.
Hey,
double
Travis,
double H. How you guys?
That's right.
H
squared.
We really appreciate you joining us today, man. So one of the things we like to get from our guests is to ask them their favorite real estate quote. What's that for you, Mr. Watts?
Favorite real estate quote. So I do have a favorite quote that you could relate to real estate, but it's not directly a real estate quote. So it's actually the Chinese proverb of, the best time to plant a tree was 20 years ago. And the next best time is today.
That's right.
Get started.
With that thought process, the time we have is now. We don't look too much back in a rearview mirror and have too much regrets, right? We just keep moving forward, understand where we are now on a knowledge base, create our investment strategy, and move forward. And I'm really hoping to dive deep into your level of thinking now and a lot of your investment strategies.
Okay, cool.
Right? I'll tell our audience a little more about yourself.
Great intro. So kind of covered some of the basics there. So started in 2009 and, I'd been wanting to get into real estate investing prior to that. It just was bad timing for me. I was moving around a lot. I was in college. It just didn't make sense for me to dive in the way that I wanted to get in. So it was kind of a little bit of luck and a little bit of pre-planning that I had read a few books of Robert Kiyosaki, Rich Dad, Poor Dad, and all that kind of stuff, like most people probably do when they first open the gate to real estate and things like that. And that was prior to the Great Recession. So I'd read some of those books in 05, 6, 7. There was one in particular that stood out. It was Rich Dad Prophecy. And not a lot of people have read that book. And all I really took away from it, to be honest with you, is we're going to have a stock market meltdown at some point. We don't know when, but coming soon. And don't be in stocks. And so that was kind of my first, advice that I really took. And I did have some stock holdings, which I had sold after reading that book. Still didn't know what to do or when or how. And then the meltdown. And so in 2009, that's kind of when I went back to step in to get started. So started in single family, like a lot of people do, worked an oil field job, 100-hour work weeks away from home.
Wow.
And worked in Saudi Arabia a little bit. And the whole point was, I'm sure we'll dig deeper into this, but the whole point was to earn as much income as I possibly could, given my skill set, which was virtually nothing, and then save as much as I could of that income to put into real estate. That was just my whole mission.
So let's talk about it for a little bit. Why did you decide to put that money into real estate instead of the traditional way of thinking or the traditional way of planning for retirement, right?
Yeah.
Of putting it in the stock market, putting it into mutual funds, right? You read the book Rich Dad, Poor Dad.
Yeah.
So obviously you had a little bit of advantage on the traditional thinkers, right? But why real estate?
Well, I had an advantage because I had read so early on before I had actually started my career and my investments, right? To really think this whole thing through and decide on a path I wanted to take. Whereas the majority of people are probably in their 40s, 50s before they really start thinking about investments and income and how they're going to retire. So I guess
not in my 40s, but I was definitely in my late 30s.
Okay, there you go. I mean, it's just the normal path, right? I mean, that truly is the majority. And so here's the difference. I chose to focus on a goal of current income. Most people aren't thinking about current income till they're in their 60s, right? They've now got this nest egg of their S&P 500 index or their mutual funds. And it's how do I create income, right? For retirement.
Right.
That's what we all get to eventually. I just chose to start focusing on that in my 20s. And so, that's what kind of prompted this whole approach to financial independence that plays into the FIRE movement. I didn't know that existed, by the way, up until just a couple of years ago, but I've always been following that process regardless. I'm sure a lot of people are in that bucket too. So yeah, that's the difference. A focus on current income where most people aren't really thinking that way in terms of investing, I guess.
You mentioned something that I really want us to dive into is that FIRE, right? So
Mm-hmm.
FIRE, from my understanding, it's an acronym, right? And
Yeah.
we'll definitely get into it. But, so you had a W-2 job where, 90, almost 100 hours or 100 hours average work week.
Yeah.
That's mad commitment, right?
Yeah.
Um,
Yeah.
so people working part-time and all they're trying to do is to get more hours at that company. But you are trying to not get so much hours, right? Why would you want to quit a job that you're so committed to?
Yeah, no, it's a good question. So, back to my point of, my skill set and kind of some self-reflection, I didn't really have any specialized skills. I didn't have any handouts. I didn't have any connections. I was just me in the world, and it seemed like no one really cared about, what skill set I had to offer. So I was in Colorado and I went to an oil and gas expo where they had a whole bunch of service providers and drillers and all this kind of stuff. And they were just hiring anybody willing to just work. They just needed to find people with discipline willing to show up and just work. It wasn't hard. It was just long hours, and it was outdoors, and it sucked because you were away from home. And so I signed up for that, just being single, no kids, wanting a higher income. And I just said, you know what, why not? Why couldn't I do that? So I took that job, and, I wasn't like built for the oil field, that's not like my, I wasn't destined to be in the oil and gas industry, as you can probably tell. And so anyway, after doing that several years and just implementing the FIRE movement, we'll go into that in a minute. I just saved a bunch of that income, basically started putting it into passive income investments so that I could eventually leave that job. So really the intent from day one was to leave that job, but to hold that job long enough to where I could get my start in real estate.
At some point, you started putting in all your saved income into your passive investments. They started making more and more monthly income. And so at some point, you made the decision to quit your W-2, right? So at some point, your passive investments were bringing in so much that you decided to quit. What was the transition like? Did you face any problems when making that transition?
Yeah. So in hindsight, I wish I'd been far more structured and had a really like detailed plan and goals and objectives. I honestly, though, I was just out there. I was doing some fix and flips, which is not passive income, some vacation rentals, which is not passive income, and then some buy and holds and things like that. And so what happened was I just had this thought one day as I'm burning myself out, basically, with the W-2 job and with the single family portfolio I keep scaling and scaling, or trying to scale. And I just thought, you know what? I set out to have 50 or 100 properties. I was far from that number, and I'm already realizing, man, this is becoming a full-time job. I can't take on another full-time job. I'm already working 2.5 full-time jobs with my current job. So I had to go back to the drawing board and figure out how I was actually going to be passive, how I could really make it passive. And that's what led me back to the education space to learn what syndications were and what they were all about. And it was real simple. I took an Excel sheet, I calculated the approximate equity in all my holdings, and I said, what if I sold everything, went all into cash, and then I came back in syndications? One at a time, 50K here, 50K there kind of thing. Mm-hmm. And what would that look like with a conservative cash flow estimate annualized? That's when I had that whole breakthrough moment of, I can leave my job. I really can. And it blew my mind. And so I was just motivated to do that because I was so burned out and desperate for a change.
Man, so that's very interesting, man. So you actually made the decision to become a full-time passive investor, right? And that's going to generate you enough income to maintain or improve your lifestyle. But in order to do that, it sounds like you had some real estate portfolio along with some savings, and you take time to educate yourself about how syndication works. You mentioned that you put $50,000 here, $50,000 there. So you're saying that if I save enough money and I decide to go into invest in a real estate syndication, I should not invest all my money into one syndication to offer me a great return?
That's a good point. So everybody kind of has their own philosophy, but there's two main ones. So you've got a philosophy of put all your eggs in one basket, but watch that basket closely, go all in on that one opportunity. Then you've got the don't put all your eggs in one basket, right? Diversify. And so I fall in that latter category. I'm a firm believer in diversification. In hindsight, had I done what you're potentially proposing, had I put everything into that first deal, the deal came through profitable, but the sponsorship team was horrible. And everything about that was just an uphill battle. battle. And so, did I have some mistakes? Yes. Did I have some problems come up? Absolutely. And it was being new to the space. I knew just enough to kind of get started, but not enough to really know what I was doing. That was kind of dangerous. And so I'm glad that I started in the way I did, because I only had a couple investments invested that way before I started learning to vet operators and sponsors. And it's so much more about the team than it is about the deal. And, the markets matter a lot. And I'm sure we'll talk about that. But yeah, so that was kind of the humble beginnings of that transition period, which did not occur overnight. It takes time to sell properties. It takes time to vet operators, and it takes time to allocate it all together and start doing opportunities. So that was like a year long, maybe a year and a half long transition period into, truly the full-time passive investor, which is what I do today.
All right. So just talk about that first deal that didn't quite work out as expected, maybe throughout the entire deal. Are you at liberty to talk about it?
Sure. Yeah.
Okay.
Yeah. I won't drop the sponsor name. But
no, totally. Please don't. Please don't. Please don't. Right. This podcast is called the Multifamily Real Estate Experiment, because every time you go into a transaction, there are certain assumptions you make, just like the scientist Heath is a scientist, right? Just like the scientists do, to make certain assumptions. Here's what we're hoping to achieve. And right, we go through different avenues to achieve that, right? Same thing with the Marine Corps, right? If we're going into a combat mission, or if we're going to a training environment, there's certain courses of actions that we go through to ensure that we are successful. So in that deal, what are some of the assumptions that were made that did not quite work out to meet the end results?
Yeah, good question. So I started kind of probably what a lot of people are still doing today, and I caution everybody listening, don't do this. But I was taking these overviews, these pro formas, right, of expectations of what's going to happen with the business plan. I was taking that at face value. I was saying, wow, 10% of your cash flow and 25% IRR. This is incredible. Here's my money, and that was
cha-ching.
Cha-ching. I found the golden ticket. And, what happened was it was a large apartment community, and this particular sponsor had never done a deal this big before. And it was a heavy rehab lift. Okay. So meaning that they were really going through these units, and they were like gutting them almost to like the studs. And they were just starting over with this. And they had all these high hopes and ambition and, optimism around this business plan. But the facts were they had never done it before, and they were way in over their heads. And as they got, through, I don't even remember, 25 units of, say, a 350 unit property, they were just running into issues. They were behind schedule. The property manager wasn't what they thought they were going to be. The occupancy dropped more than they hoped. I mean, everything was going wrong. And they just saw the writing on the wall and said, you know what? There's some equity in the deal because we bought it at a good price. We're just going to sell it. And so what was a 5 to 7 year hold turned into an 18-month hold in total. We got out at profit, but did not meet expectations of the investors in any way. Wasn't the worst. And so that's a good point that you bring up. So there's 3 factors, right? There's the sponsorship team and the business plan, and there's the market that you're in, right? And then there's the deal itself and, price per door, and did you get a good deal or not when you bought. So they had bought at the right price, and they were in a good market, but they could not execute the business plan. So 2 out of 3 were working in my favor, which is why it ended up being profitable, and why I love B and C class multifamily in general, which is what this was. So yeah, it was close.
That is definitely good. So one of the things we talk about on this Multifamily Experiment podcast is that we need to be able to have flexibility, knowing when to exit a deal based on the way the business plan has been executed. So it's good that they had flexibility and was able to be profitable.
Yeah, no, it is. And it probably would have been a much bigger disaster had they held it longer, and kept repeating their issues. So I'm happy all in all, but it was a learning experience.
We as syndicators, we want to know how to make sure we're taking the best care of our investors. And so when it comes to vetting your sponsors now that you've had that previous experience, what are some of the attributes that you look for? And you can say, oh, this sponsor is going to be taking care of their investors better than this other pro forma I just looked at.
Yeah, I think to start from just the high level, you're going to be in a partnership with these folks that you're vetting out. Okay. Like think of it like a friendship that you're going to be locked into for maybe 7 years. Okay. So if you're not getting along from the beginning, if they're not answering your questions the way you like, if you can't have just a normal conversation and have value from that, that's probably a red flag. right? Because now you got 7 years of that. That's going to be hell.
Wow.
So,
That's a long time.
so just start with liking the individual you're working with, right? Like just common sense stuff if they're going to be like a business partner. And then two, nowadays, I look for, let's say it's a new group and they don't have the track record or the experience. Well, I still look for, do they have a mentor or do they have somebody they can pull in as a consultant? Is there anybody on the team that does have the experience, right? It doesn't have to be but at least have that element to it. So yes, I look for track record and whatnot and experience, but with that caveat, I guess. I have invested with newer groups that did well. So I'm not against that. And what else I like, no one really talks about this, but I like consistency of business plan. So there's a lot of groups out there that they're trying to get their hands in everything. Today it's a multifamily value add and tomorrow it's self-storage and then it's a new development deal, then it's a mobile home park. You just can't be good and specialize at everything, right? Unless you have this massive team with, a specialist in each of those arenas. It's just very hard to pull that off. Some deals are going to do great. Others might flop. I just don't want to roll the dice. You know what I mean?
Gotcha.
So I like groups that do the same thing over and over and over and over again. And they can show that experience and say, look, here's our past results. They've been great. So that's what I look for.
This is a common theme that's been throughout a lot of the people that we've interviewed so far, is to focus on one particular strategy and go vertical as opposed to applying what you've learned across different areas. Moving laterally isn't as productive as focusing on one, and that makes you go vertical. So that's how you vet the sponsor team, and that's really good. Now, say you have a sponsor team who you feel to be in a good relationship for the next 7 years. How do you then vet the business plan?
Good question. So to me, using that example I used previously, so you've got a brand new group that's never done this before, that has a very, very heavy lift that they're going to try to pull off. That right there in itself is probably a red flag, right? You're going to need to ask a lot of questions and know the answers to this. I look for more like the reverse of that. I look for a team that's been doing this over and over again that does lighter lifts and brings a lot of experience to the table, because the likelihood that they're going to be able to execute on that goes way up and your risk comes way down. So there are folks that specialize in heavy lifts and complete turnarounds. They'll buy a property with 50% occupancy and they'll bring it up to 100, that kind of stuff. But that's typically not who I'm working with. And another reason that's personal to me, I'm just looking for steady, consistent, preferably monthly cash flow because it's my income. So I'm not so much in this new development or, hey, in 3 years, we hope to sell at this price. I mean, that's kind of like picking stocks. I'm just not as interested in that. My emphasis is on current income.
What markets are you currently in, and why are you choosing those markets?
I'm in quite a few markets actually, and here's the deal. To make it as simple as I can for your listeners, this is what I do. I do my own independent research from a very high level. Okay. Where are people moving to? Where are people leaving? Is the state in general a landlord friendly state, or are they not? Do they have rent control? Do they not? I mean, I'm just looking for certain things from a very high level. And then I'm deciding, okay, I like whatever, just to give some examples, Georgia, Florida, Texas, there's some states that I like, even Arizona in some cases. So from there, then obviously you have markets and submarkets and all this. Well, you could spend your life trying to analyze all this stuff, but I'm not going to do it, number one, and I'm probably not going to be very good at it. So then what I do is I partner up with groups doing deals in those states that I like, and I let them fill me in on the specifics to the submarket that the property's located in. I don't know all the jobs and employment around there. I don't know the median household income in a 3-mile radius of Irving, Texas. But if I'm going to do a deal there, I'm just going to let the sponsor tell me what that is and then make a decision on that makes a lot of sense, or no, I don't like that at all. That doesn't seem to match the business. So go macro and let everyone else fill you in on the micro. That's my advice.
I think where you're at is where a lot of people who get into real estate want to be at some point. You get in, you may start with single families, you may do fix and flips, you may do burrs and buy and hold. Everyone who's listening to us are thinking about getting in multifamily or are in multifamily because of the economy of scale, how you could then scale up your portfolio and your passive income. Could you give us a little bit of a walkthrough of how you are able to scale your portfolio so large and so quickly? You're invested in 27 deals?
Yeah, I mean, obviously that's a scalable model. If I had 27 single family homes, I wouldn't be on this interview. And there's certainly people that can do it. I'm not trying to bash that model, but even even with a property manager, which I did have at the very end of my single family days, there's still a lot of active that has to be done. There's a lot of decision making that has to be done. There's a lot of stress and anxiety I didn't like, because even with a property manager, right? Say your hot water tank goes out or your roof needs to be replaced. Well, guess what? You still have to make a decision on that, right? And you still have to vet out the contractors, and it's not that passive, right? It can be for rent collection, maybe on most properties, hopefully, but then there's always things that pop up. And so syndications are completely hands off, completely passive. It's just a little bit front loaded. So you're vetting a sponsor and you're vetting a deal and you're making a decision one time for however long that takes you. You're wiring your funds and then it's over. Sit back for 5 to 7 years. You don't have to make any decisions. You don't have to ever manage tenants, saving all your write-offs and receipts, that I would always lose and it would just piss me off. So there's,
I know the struggle, man.
It's very scalable in the sense that whether I have one syndication deal or I have 100, it's not taking my daily time, my weekly time, my monthly time. Only making decisions when you sell a property and what to do with the money, and then which property to invest in up front. So that's what makes it scalable. And everybody's different. There's really 3 types of people in this space. There's the people like me, and that's pretty rare, that are just 100% passive and that's it. Then there's the folks that are 50-50. And I think that's very smart too. So like my dad has 8 single family homes. That's his retirement strategy. But he fully recognizes if he were to have 12 or 15, it's going to turn into a job that he doesn't want to have in retirement. He still wants to vacation and have freedom. So he's done 8, capped it, and now he does syndications to layer on top of that. Now he can have infinite amounts of syndications. And then you've got folks that just want to be active. They want full control, full decision making, and rightfully so. There's a lot of folks out there good at fix and flips and they're handymen and handy women. And that is great. I'm not that. And so, it wasn't the most efficient model for me having to contract everything out. 1, I didn't want to do it. And 2, I didn't know how to do it. So different strokes for different folks, right?
You frequently talk about the FIRE movement. You are very passionate about this FIRE movement. So wanted to help listeners to understand a little bit more about this FIRE movement and why is it important to any kind of investors going forward who's looking to maintain, improve, or just create a great life for themselves?
Yeah, absolutely. Happy to share. So for those unfamiliar, and it's not a huge movement, by the way. So if you're not familiar, you're in the norm. I've been doing this pretty much my whole life, and I just learned about it a couple of years ago. So, all new to me too. But FIRE is an acronym, as you pointed out, for Financial Independence, Retire Early. You talk to 2 types of groups, people that are passionate and love the subject and those that scrutinize it. And I think the scrutiny is coming from lack of understanding what this is really about and why. This is how I explain it. Forget about the RE, right? FIRE. Forget about retire early, because I think that's where people get confused. A lot of people can only think of retiring in terms of old age and retirement home and playing golf the rest of your life and whatever, sitting on the beach. That's not what this is. Let's focus on FI, financial independence. The concept is make as much money as you can, save as much as you can, and invest the difference. No matter what your background or skill set, that's what I did, as you know, from the oil field. And whether you're a doctor or attorney, whoever, right? You just, whether that's side hustles or whatever, you're just trying to earn the income and put the rest into investments. A lot of people, what they do in this movement is they pile into a low cost index fund, like a Vanguard Total Stock Market Index Fund, VTSX, I think is the ticker. So here's my issue with that is you're subject to the huge swings in the volatility of the market. I don't know when this podcast is going to air, but in the last week of the market, we've been up 4%, down 3%. It's just been chaos. I say, instead of going into the index funds, go into real estate, which is a whole lot less volatile, specific to multifamily and syndications, and just focus on, current income. So let's run some numbers. A lot of people follow the 4% rule. A lot of you may have heard of that. So a lot of financial advisors and traditional Wall Street's going to teach you about a withdrawal rate from your portfolio in retirement of 4%. And the theory behind this is that the portfolio on average, is going to be making like 8% a year. That's the stock market's history in the last 100 years. You're going to be withdrawing 4%. So theoretically, you're going to have this infinite yield curve, right? Because your whole portfolio is compounding as you're withdrawing only half of your annual earnings. Okay, so that's like the most conservative approach. You can apply that to real estate. You can totally do the 4% rule. You just do it off cash flow. So if you're making 8% cash flow, you're just taking 4 off the table and living on it, and then letting the other 4 compound and go into other projects. project. If you want to be a little more aggressive in the professional investing space specific to real estate, it's not uncommon. In fact, it's probably the norm to be more in like that 8% range of annualized cash flow. You can use 100% of that. Okay, so here's the numbers if anyone wants to write this down and do this. So here's how you factor how much money do I need invested to live on? That's everybody's question, it seems, in the retirement game. They can't put these things together, but it's quite simple. So let's say that you need $40,000, just to use a simple number, a year in income. If you want to use the 4% rule and be as conservative as you can possibly be, in my opinion, so you take 40,000 times 25, that equals $1 million. So you need $1 million invested, whether you're doing the index funds, whether you're doing real estate, to be able to take 4% of that a year, which is 40,000, and live on that. Now, to use that 8% example, same thing, it's 40,000 times, and then you're going to go with half 25. So 40,000 times 12.5, and that's going to take you to 500,000. Right? So you need 500,000 invested at 8% or $1 million invested, at a 4% rate. So that's how you can break that down just in simple terms. That's not a guarantee. That's just a very conservative way of looking at how you can retire. So when I told you earlier that I took out that Excel sheet and I ran numbers on selling all my properties and then investing those at a conservative cash flow number, back then that was 8%. That's the number I used. I realized that was enough income to leave my job. And that's what I decided to do, because I wasn't going to last, till my 60s, working out in the oil field. So I knew I had to get out sooner or later. It's like, why not now?
You'd be able to enjoy your retirement from being what happens when you get worn down, your body's not able to enjoy it.
Yeah. So, and the last thing I want to point out is the purpose. So yeah, okay, the numbers and the analytics, and you get the concept, but why? So this is why I like to retire early, because very few people in their 20s, 30s, 40s are going to just retire, right? And do nothing. So you still want to be active. That's where it gets scrutiny, is people make fun of the fireman. Oh, you're retired, right? But you still work. Well, yeah, because you still want to be productive, which is what I did. So I had the financial independence to leave my job and to be self-sustained. However, I didn't want to just quit contributing to the world. So one of the first things I did is I went to go work for a brokerage firm to learn stocks, bonds, and mutual funds, believe it or not, from kind of the inside, right? I wanted that, I know it's goofy to think about, but that was actually what I wanted to do. I guess thinking if I could master that stuff plus real estate, I'd be some financial guru. Anyway, I quit like 6 months later. So yeah.
That's the best story right there. I love it.
But
yeah, so
you had the luxury, right? You've created a situation where you can do that. So the
that's my point. Yeah.
Yeah, I think that's the key takeaway from that. Fire movement, retire early. You got to choose how you spent your time bettering yourself and the world around you, because you were able to live off the income from your investments.
Right.
And your investments into real estate are less volatile than they are in the stock market. And so you have more confidence that what's going to be coming in each month is going to be consistent compared to something, dropped around the world, overnight, and now you're not going to be getting as much as you thought you were that much.
The concept is the freedom of choice, right? It's having options. That's what it's about. It's just having options. So whether you want to work some people just want a career change. They don't want to quit working. They just don't like what they currently do. But there's this fear around living paycheck to paycheck. I can't quit. I can't go 6 months without a paycheck. So they never leave. They just work till their 60s, right? And so whether it's just a career change, or it's moving from full-time to part-time, or it's traveling the world, or it's spending more time with kids, or having a spouse, be a stay-at-home, whatever it is, everybody has their why and what they would do. I've heard that question asked my whole life. If you had $10 million in your bank account, what would you do? Everybody has an answer to that.
Buy real estate.
Buy more real estate, have more cash flow. That's what I would do. But anyway, yeah, so that's kind of the beauty of it, right? It's just giving you true freedom just as a human being to make choices that you otherwise may not be able to make.
I really appreciate you dive into that for us, because who does not like choices, right? No one wants to feel they're bound to any, especially something that they do not enjoy, right? Because we often hear that a lot of people they wake up every morning early as heck, drag themselves to a place that they do not want to be, so understanding the mindset that, look, I can retire early, or I can create a financial situation through passive investing that give me option to live the life that I choose. Pretty much choice.
Yes.
Yeah. I greatly appreciate you diving into that. We're going to roll right into that focus round. FOCUS. Fun, opportunity, communication, understanding, and success. What do you do for fun, Travis?
Some people are going to laugh at this. I've always been a huge advocate of self-education. If I could block out the next 2-3 weekends with absolutely nothing to do, I'd be reading books and I'd be watching a few documentaries I haven't been able to see. I just love learning, audiobooks. There's just too many. I've probably got 25 on my list, and it's hard to get to. That's what I would do because I get a lot of fulfillment from that. That energizes me when I'm learning new concepts and I'm moving forward and progressing. Self-education, reading.
Yes, success through clues, right?
That's awesome. Well, it's cool whenever you can merge something that you're enjoying doing with something that's self-educating and making you a better person as well. So that's pretty cool. I like it. What is one opportunity that was a game changer for you?
So what we were just talking about a few minutes ago was the point of the FIRE movement, and not necessarily retire early, but have flexibility to do what you're passionate about. So the game changer for me was being able to work with groups, Ashcroft Capital specifically, where now I get to travel around 2 different venues and seminars and summits, right? To talk about what I do. Who doesn't want to do that? To educate other folks and just to be in an ecosystem and a network of like-minded people. So I can't think of a better thing that I would be wanting to do with my time right now than doing that. And so that's been a huge game changer, is to be able to help others in that world in multifamily and with syndication.
So you're a relationship guy, right?
Yeah.
So taking time to do your reading, which is fun for you, is absolutely amazing, because everything you're absorbing, you're having fun, and it's also helping you to get better at what you're doing, creating great relationship, right?
Absolutely.
So what would you say is your most important communication tip?
Most important communication tip. I think just being transparent with people, right? Whether we're talking about a syndicator and limited partners, or whether we're just talking about human beings, but just laying it out. Something that's coming to mind for some reason right now is there was this deal that we had. I'll just use Oklahoma City as the example. So a tornado comes through, it misses the property. That group never sent out any form of communication about that. And so then what happens in turn is that you have all these concerned investors writing in to the sponsors. What happened? I saw this on the news. Are we okay? Did it hit the property? And it's just being proactive and transparent about yes, this happened, everybody, but we lucked out in this case, and just kind of just communicate with people. I'm struggling for the best term to use, but transparency, proactive, and just communicate with people.
I like the proactive portion of it. Instead of the investors pulling questions from an operator, the operators are pushing information to the investors, which creates peace of mind.
It does.
I think that's important.
Yeah, I think the proactive tip is a good one, and I hope our audience is picking up on that, because that's exactly what you need. You need to let people know it's coming before they ask you, right?
This could be related to anything. I used a real estate example there, but if you got a meeting with someone at 6 p.m. and you're going to be late, hit them up 45 minutes early and just say, look, man, I'm going to be late. Don't show up 15 minutes late and then, oh, sorry about that. Just be proactive and be transparent. Here's what happened. I forgot about it, but I'm on my way.
All right. You understanding. What is one thing you wish you understood sooner?
I would say taxes. This is kind of a weird topic. So I never got into real estate because of taxes. I clearly didn't understand taxes when I was doing a bunch of short-term flips and things like this, and the way I used to invest. But I read a book called Tax-Free Wealth, written by Tom Wheelwright. And that book alone just opened my mind so much. I switched CPAs. I changed my whole philosophy around investing to be more long-term and in highly tax-advantaged investments, like apartment syndications as one example. And I can't even tell you, a lot of people are paying 30, 40, 50, sometimes even as high as 60% of their overall income in taxes. Folks living in California, high income earners, you add it all up, Social Security and Medicare and state and federal, and it's insanity to think, what if you were in investments where you could pay zero tax? Or what if you could reduce your taxable income by $40,000 a year? That's like an income in itself. So that's been kind of the flip side of this journey, is first getting in to make money, and then second getting in to save money. And it's just been a total mind shift. And nice. I wish I had read one of those books early on. I don't know if it would have sat with me, but it would have planted a seed. So
Right.
Throughout this podcast, we can make several assumptions as to why you're successful, Travis. So working 98 to 100 hours per week, that is some commitment. So
It speaks to
obviously,
your character, right? Yeah.
you love to read, you love to grow, you participate in the lifelong learning, right? So obviously that's a contributor. Your dad is in real estate, so that kind of gives you a little bit of background about real estate as well, too. But that's all my assumption. To what does Travis attributes his success?
self-discipline is how I would describe that first bullet point. And that is tough. And it's tough to stay consistent with it, to hold yourself accountable. I mean, I'm sure you know this like clockwork, but
Marine
yeah,
Corps.
yeah, Marine Corps. Absolutely. I can't even imagine, but yeah, a lot of folks aren't. And there's different philosophies around this. And I'd say for your listeners, don't subscribe to this YOLO, which is another acronym you'll love. You only live once. Because that philosophy is so much around, you got your paycheck today, you might as well blow it because there may not be a tomorrow. Lose that, right? And become a little more stoic and a little more disciplined and, defer to a later date, basically put it away today. There's another quote out there, like, oh, if you live a few years, like most people don't, you can live the rest of your life like other people can't, something like that.
Right,
and
right,
I'm a firm believer in that. Holy cow, even as short as 3 to 5 years of self-discipline, if you can just do that, you don't have to worry about it after that.
So YOLO, I kind of like YODO. You only die once.
Okay.
Understanding that the other spectrum of it is that you live every day.
Yes.
Right. And understanding that if you want to really live instead of just existing, it takes some sacrifice at some point. Something has to give that doesn't really matter in life, right? To the things that really matter. And the things that you're trying to achieve that really matters might not be happening now, but you can create a situation where it happens in the future. You know what I mean? So live every day. Appreciate you taking time to join us on this multifamily.
Yes. Thank you so much for agreeing to come. We appreciate it. So if our listeners wanted to get in touch with you, how would they go about doing it?
Email is probably the best. You can reach me at travis@ashcroftcapital.com. I'm also on Bigger Pockets, LinkedIn, Facebook. So you'll find me. My last name's Watts, Watts, Travis Watts. So love to connect with anybody. That's how I spend a lot of my weeks, is just connecting with all types of real estate investors, and not just to talk about syndications, but, I've done a lot of the house hacking stuff, and I've done the flip stuff. And, there's just a lot of models and strategies and resources that I have that I'm just happy to share openly and for free. I'm not pitching anything. I don't sell anything. So happy to connect. Reach out.
Awesome. That's incredible. Thank you for the offer, man. That's really nice. I guess that's all we have today, Hutch. What do you think? It was a great episode, man. I was taking
amazing
notes left and right. I got some stuff that I needed to start thinking about. So we appreciate it, Travis. Thank you again for coming on. So,
all right, Heath and Hutch, thank you.
Thank you, Mr. Watts, Travis. You take care.
All right. I'm Dr. Heath Jones.
And I'm Hutch, the Marine Investor. Out.
Sweet.
Cool.
All right, Travis. So what advice would you give to someone who is dabbling with the idea or considering moving into becoming a full-time passive investor?
Yeah, good question. I think it starts with self-education, as we spoke quite a bit too. And more specifically, so I have a free passive investor resource guide as an example. So your listeners can find that at ashcroftcapital.com/passive investor. And the reason I point that out, it's about a 20-page PDF that goes into a lot more detail about things we talked about on the show. So how to vet a sponsor, how to vet a market, how to vet a deal, common terminology, knowing yourself, knowing your goals, right? We talked about, do you want to be active? Do you want to be passive? Do you want to be a little bit of both? So really, it just starts with having those types of conversations. And so that's a great resource for your listeners.
All right.
Excellent.
Greatly appreciate it.
All right. Yeah. Thank you.
Cool.